just think about it. If you have a 2% mortgage, how low do interest rates have to go before you actually respond to that, right? Interest rates would have to go below your previous financing, right? So you'd have to have even more easing. And so that's when I talk about a harder landing. I think in many ways in the way that the Fed was constrained or struggled to slow the economy when it was going on this upswing, it may very well face the same structural pressures to ease effectively as the economy slows down.
Bob Elliott, co-founder, CIO, and CEO of Unlimited. It is so great to see you, and it's great to welcome you back on the show. Thank you so much for joining me again, Bob.
Yeah, thanks for having me. Excited to be on again.
Well, I'm excited to have you on, especially with everything going down these days. And so let's kick things off where we always start the show, and I want to get your updated macro view, the big picture for you today. What does that look like where we stand today?
Well, I think we were in a period for almost a year where many folks were expecting a very fast recession, and that obviously has not transpired. If anything, like basically unemployment rates today are the same as they were a year ago. It's not to say we haven't seen some slowing of the economy, but the sort of recession now that had been expected both at the beginning of the year and also right after the SVB situation hasn't materialized. And the reason why that is because the economy is not as sensitive to rate hikes as I think many people expected. And on top of that, macro cycles, take a long time to play out. It takes a long time for that elevated set of interest rates to flow through to slowing borrowing and slowing economic activity. But I think the thing that is particularly interesting today is that just at the time when, after a year of no recession, everyone's giving up on recession, right? In the asset markets, how things are being priced is basically that we'll have a no landing or a soft landing scenario. Just as that's happening, we're actually starting to see the dynamics that would typically align for a recession on a forward-looking basis. And so I think that's a very interesting circumstance because particularly as you're trading financial markets, you're always trading against what's priced in or what the consensus expectation is. And I think just as, everyone has given up on recession, the probabilities of it have gone up considerably in the last few months.
Yeah, as everyone's giving up on it, the probabilities have gone up. And you can correct me if I'm wrong, but I believe if you go back a year ago, you weren't expecting a recession. Remember that there's that article that came out, it was like 100% probability. I feel like you were not expecting it, but I do want to get a follow on here. If suddenly asset prices are pricing for the no landing, soft landing, but yet the dynamics are aligned for a recession looking forward. I want to hear more on that. And are you now expecting a recession go forward?
Well, yes, I'm definitely expecting a recession. To be clear, I always expected a recession, but what I said a year ago was that the recession would be much later than people expect and also much harder. And I still believe that dynamic is playing out. If anything, it's been even a little later than I was a totally non-consensus when it came to how late it would be. It's been even later than I expected. I was thinking that it would be the last couple of months of 23 a year ago. It looks like for a variety of different reasons, particularly tied to sort of the mini stimulus that has occurred on the fiscal side of things. We're probably pushed into sort of, March, April of 2024. But there will be a recession. And when I say that conditions are aligning, you're getting the type of typical dynamics that lead to the ordering that creates the recession, which is that we had a tightening on the short end. We've now had a meaningful rise in long end interest rates. We're starting to see stock prices fall in response to that. They haven't fallen that much. In fact, they haven't even fallen that much relative to how far bonds have fallen, but stocks are starting to fall. And we're starting to see the underlying weakening in those cyclical sectors, as well as in the labor markets, which are starting to soften a little bit in a bunch of different ways. And that whole dynamic is basically putting us on a path where, something like 3 to 6 months from now, we're most likely to see a deterioration that's coming at a time when, particularly when you look at the equity market, expectations of earnings growth are relatively extreme. Right now, the equity market is pricing in a 25% increase in earnings over the course of 24 and 25. So that's pretty high. particularly when you think about, what nominal GDP growth is likely to be. And so that's really the divergence, which is very, very high expectations of earnings growth in the bond market, in the stock market, at a time when we're starting to see those macroeconomic dynamics align for a recessionary experience in early 24.
Yeah. One of the things that tends to happen, there tends to be a lot of focus on like the stock market. I guess when you do more like financial TV, it feels like there's so much focus on the stock market. Yeah, I want to hear more on like what is going on in the bond market. And I know you've been following this very closely, you've been putting out some great tweets, but maybe even for like the more of the lay person, if you will, can you just frame up what's been happening in fixed income specifically?
Bonds are usually the boring market, right?
Yeah.
But they've been, they've had, if the stock market had gone down 50% the way the long end bond market has gone down, I think everyone would be noticing, and few people talk about bonds. And basically what's happened there in many ways is a somewhat typical dynamic, which is we had a relatively depressed set of bond yields. We had a hot economy. The Fed tightened. That tightening on the short end basically dragged up long end interest rates for a while. But because there was expectations of recession, particularly if you go back sort of a year ago or just after SVB, long end bond yields remained relatively low in comparison to the short end that the Fed was dragging up. And so that set of dynamics was basically pricing in an immediate recession. Now, what happened over the subsequent 6 months is we haven't gotten that immediate recession. And as a function of that, two things have occurred. The first thing, which is important, is that there's been a pricing out of immediate Fed cuts. And so as the short end basically rises, right, as fewer cuts are priced in or higher yields are priced in on the short end, that leads to longer end yields coming up. And that's because, long end yields are the average yield over the course of, over 10 years, let's say. And so what happens on the first 2 years and the expectations in the first 2 years has an effect on that long end bond. And then the second effect, which has been material really in the last 6 or 8 weeks, has been a recognition of the significant supply that would come to the market. It was depressed, particularly the government supply was depressed, particularly around the debt ceiling circumstance where, of course, the government couldn't issue new bonds and new duration as a function of that. That the reissue of longer term bonds was delayed slightly because bills were first issued and now long end bonds are being issued. Most people became aware of that centered around something called the QRA, which is the quarterly refunding announcement that the Treasury makes to talk about what sort of debt issuance they're going to do. That highlighted that the Treasury was going to need to issue a lot of bond supply, particularly longer duration bond supply, and that created an effect on the long end, which further caused those bond yields to rise in order to incentivize new buyers into the market. I think the main thing when you see that whole dynamic is a lot of the stuff that we just talked about, or I just talked about, is behind us rather than ahead of us. So Fed cuts have mostly been priced out. The increase in bond supply has basically occurred. It's occurring now in the market. And so the real question is going to be on a forward-looking basis, what are the various dynamics that are actually going to create an even further pressure on the bond market? And right now, the bonds are down 50%. Yields have risen hundreds of basis points, and they've risen almost 100 basis points in a relatively short time frame. There's not a lot of next incremental catalysts to drive bond yields higher from here.
So help me understand what all of that means. Is there going to be an opportunity to buy bonds, or and I know maybe that's my really awful question, but I'm just trying to understand what folks are doing in this space.
Yeah, well, I think you basically have a circumstance. The two things I'd say, first of all, when you think about the bond market, bond sell-offs are actually self-correcting. And that's an important thing to think about when you're thinking about bonds, which is when you have a rise in bond yields, there's basically two elements that occurs. One, they become more attractive because the yield rises, and so your expected forward return rises, and that often brings in yield sensitive buyers. And that's what we're seeing. Like, you're seeing TLT, which is the ETF, the long dated treasury ETF, has in price terms sold off as bond yields have risen. But what you've seen is a lot of buyers come in because they start to say, well, bond yields at 5%. I haven't seen that in 15 or 20 years. That's actually a pretty good opportunity to come in. There's good value in those securities. So they're coming in. Yield sensitive buyers are coming in. And I think the second thing, which is important when you're thinking about bonds, is that by their nature, the rise in bond yields creates a drag on economic activity, right? Through higher mortgage rates, higher auto rates, all those sort of borrowings that you do. And that drag on economic activity limits future borrowing, particularly by the private sector, which then creates a slowdown in the economy, which creates a bid for bonds. And so when I talk about the bond dynamic, we're basically seeing a constellation of things because bond yield rises are self-correcting. We're starting to see that sort of natural floor that's coming into the bond market. And the thing that's interesting is if you just compare that to the equity market is self-reinforcing in terms of the price action. And the equity market is only, whereas bonds are down 50% from peak, the equity market is down, not much is the short story. And so, when you think about which markets are more or less vulnerable, most of the repricing has happened in the bond market, whereas we haven't really seen a meaningful repricing in the equity market.
That is okay. That is really interesting because, if they're signaling like, look, we have higher rates, that goes out into like, I guess, broader economic activity, like not wanting to get a mortgage because of the high rates or auto loan, all of that. Okay. And so if you're a company too, like I guess even issuing debt, you'd have to pay back at like even higher rates right now too, wouldn't you?
Right. Which is a reason why you wouldn't want, if you could do anything you possibly can do to not borrow right now, you'd basically do it, right? Because the interest rate is so elevated relative to history or income growth and things like that. So that's when I say as yields rise, it actually stops the incremental borrowing that would typically occur from the private sector.
Which would, that can be, I wonder, okay, so bond market, I suppose, could be a bit of a sign of what could come in the economy then.
That's right. Right. Naturally, there's macroeconomic linkages. I think part of the story that we've seen that's confused people is there's been a lot of increase on the short end. And the reality is that the U.S. economy doesn't really, very few people borrow on the short end. Basically, most corporations, they don't issue floaters anymore. Most households aren't borrowing, floating rate mortgages and things like that. They're borrowing on the longer term. And so the challenge with that is there's basically two things. One, the incremental borrowing happens on the long end, and so it's the yield on long-term bonds that actually is a much bigger driver of credit costs in the economy. And so until those rose meaningfully, we actually didn't have as much a tightening of credit costs as we had move in short-term interest rates. And then the second point, which is it also just takes some time, which is that, if you've already borrowed on a long-term basis, let's say 5 or 10 years, you're not, it doesn't matter what exactly is going on with interest rates today, but basically corporations in particular, to some extent households, there is a fundamental or baseline need to borrow over time, which can be sort of pushed off for a short period of time. But eventually, like, people move, houses for all sorts of reasons, right? Like, you get married, you get divorced, you have kids, all these sorts of normal baseline reasons why people have to move. And so, there's going to be borrowing that happens over time. And similarly, corporations have financing needs, particularly those corporations with negative cash flows have financing needs on an ongoing basis. And so, while they can delay 6 months or a year, eventually they got to come to market. And so that's why the duration of time is actually so important when you think about the effect of interest rates and elevated interest rates on the economy, because anyone can delay for 3 or 6 or 9 or 12 months, but eventually folks have to borrow.
Okay, so the higher for longer, it's about the longer part and how long exactly.
That's right. Right. It's about the longer in order to have the effect on the economy.
Yeah. So let me tie this back because earlier, and I'm taking notes, and that's why I love having you, because I feel like I learn a lot from you too, Bob. When we were talking about a recession, that you said it would be much later and much harder. Could that is that part of that equation? Do you still expect the recession to be much harder? And is it because of like perhaps the duration of how long we stay high?
Well, I think there's two things. One, the point about how long we stay high is really important, because if we think about some recessions that we've lived through over the course of our lives, we've had relatively contained inflation pressures during those periods, right? Mm-hmm. 2000 cycle, the 2008 cycle. No one was really talking about inflation as a concern. That's not the case today. And so the fact that inflation has come down meaningfully, but it's still elevated relative to the Fed's target. And there's still, having just gone through a period of quite elevated inflation, the Fed is cautious to deliver monetary stimulation until they're really sure that there isn't going to be a reacceleration of inflation. So that's going to cause the Fed to maintain elevated interest rates for longer, right? That's a pressure to maintain elevated interest rates for longer. And then the second thing is, in a lot of ways, we've sort of all looked at this cycle and we've said, wow, this economy doesn't seem so sensitive to interest rates on the upside, right? It's taken a while to slow the economy on the upside. Well, on the downside, the dynamic is very similar. Just think about it. If you have a 2% mortgage, or a 3% mortgage, how low do interest rates have to go before you actually respond to that, right? Interest rates would have to go below your previous financing, right? So you'd have to have even more easing, more extreme easing, because in order to get any benefit from lower rates, you'd have to basically, from refinancing, have to move the rate even lower than the extremely low rate that you had before. And so that's when I talk about a harder landing. I think in many ways in the way that the Fed was constrained or struggled to slow the economy when it was going on this upswing, it may very well face the same structural pressures to ease effectively as the economy slows down.
Hey there, I just want to quickly interrupt the video and just say thank you. Thank you so much for coming to this channel and choosing to watch this interview. I hope that you are enjoying it, and I appreciate you visiting the channel. If you like what you see, please hit that subscribe button. It doesn't cost anything. It's totally free, and it will keep you up to date on all of my interviews. I post 2 interviews a week with some of the most incredible people in finance and investing, and your support will help me bring in some more amazing guests. If you already are one of my subscribers, thank you so much. I cannot express to you how much your support means to me. I am incredibly grateful that I get to do something that I'm truly passionate about, and you being there week after week, it not only gives me that energy, but it just gives me that faith to keep going, and it means everything to me. And I love seeing you all in the comments section. I love interacting with you. I love interacting with you on email or social media. I just love hearing from you all, and I just appreciate your support so much. I feel incredibly lucky that I get to do something that I just love. So I just want to say thank you and appreciate you subscribing. All right, back to the interview. Okay, I know the Fed wants to remain resolute in this whole 2% target for inflation. How reasonable do you think that target is? Because look, we've had unprecedented rate hikes. Still seems to be an issue. So
yeah, well, the 2% inflation target is, I think there's a number of folks that are challenging the idea of the 2% inflation target. And, the Fed has and Chairman Powell has pushed back quite strongly on that point. And I think for good reason. And the reason why that is that 2% inflation, a 2% inflation target, just naturally when there are economic upswings is likely to move sort of into the high 2s and 3s naturally. And when there are downswings to move down towards 1. And by keeping the target at 2, what that allows you to do is ensure that there isn't deflation because you're sort of above zero enough so that even in an economic downswing, like what we saw in the 2010s, you still keep inflation positive and don't have those deflation dynamics that started to emerge in places like Japan. But also the key thing is on the upswing period, not getting inflation up into the 4s and 5s and 6s, because when you get that dynamic, the probability that you see future inflation above 4 if inflation is at 3 is multiples higher than the probability that you see inflation above 4 if inflation is at 2. Right. And so that's kind of the thing, is because inflation, because of a variety of different self-reinforcing dynamics that we've basically experienced over the last couple of years, inflation is reinforcing on itself. And so it's critical to keep it contained to help prevent the risk of a reinforcing inflation dynamic, frankly, that we've seen over the last, couple of years.
Yeah. I want to ask you this too, because I'm sure you saw this just a few weeks ago. Jamie Dimon was talking about being prepared for 7% rates. How likely do you think that kind of scenario might be?
I think it's pretty unlikely, but I think his comments were sort of taken by many folks in the financial media as a projection, rather than, I think the intention of that was to say, if you're a bank risk manager, you have to be thinking about a wide range of plausible outcomes. And is 7% probable? No, it's not probable. But if I was a bank risk manager, it's certainly plausible enough that I would want to sit there looking at my bank and saying, could we absorb a 7% interest rate, and how do we prepare for such a move? And so I think in some ways, like, what he was speaking to was the low probability but plausible tail risk that we have even further elevated interest rates from here, rather than the most probable scenario, which is, we're in the ballpark of probably where these rates will peak at this point.
Got it. Yeah. And it probably, if I had to guess, it made for like a really flashy headline, if you will. Or
a
something.
Great headline, right? That's financial media is very good at
and I'm a former financial media person. So.
Well, now you're doing a longer format podcast. So I think that, in a lot of ways, you have to have a good quality conversation, which, a lot of this stuff is complicated. It's not, it doesn't work in sound bites nearly as effectively.
You are speaking my language, because that's how I always felt, was that I always push for longer form conversations, not sound bites, with incredible investors and folks like yourself, and the ability to ask questions and not be embarrassed if you ask what might seem like a naive, or like, it's complex. It's not like you go and learn this stuff at school. It's like I learned from experts like yourself who've been in this business for a long time, working at, some of the most well-known and respected places. So that's why I appreciate people like you, Bob. So I want to ask another, just like given the dynamics taking place, the macro picture, and you don't have to give specifics if you don't want to, but where do you want to be, or how are you thinking about being prepared or allocated, if you can share more there?
Yeah, well, I think for let's say most investors have some form of the 60-40 portfolio, right? Some stocks, some bonds, 60-40 meaning 60% in stocks and 40% in bonds. And, the point of that portfolio, or the genesis of that portfolio, really came out of the last 30 to 40 years, where we've had a long-term disinflationary trend, right? Inflation has come down meaningfully, where we had very strong growth and particularly strong productivity growth in the economy. And also a period where we've actually, seen some of the lowest international conflict that we've seen, in modern human history. And so in many ways, people have gone to the 60-40 portfolio because they've seen it do so well during that time. And the problem is that at this point, the 60-40 portfolio is really an all-in bet on disinflation, strong growth, and peace. And those things may very well happen over the next 10 years, let's say 10 or 20 years, but there's certainly a probability that they don't, right? We've seen an inflationary period. And so the idea that we might have further inflationary dynamics in the economy should be present in people's minds. We've obviously seen a period of lackluster growth for an extended period of time. And we've seen, we've gone from a period of international peace to, a heating up of geopolitical conflict. And so, you think about all that, how do you protect yourself, right? How do you get prepared for an environment that may be different? And how do you hedge against that? I think really for most investors, there's basically two easy ways to get to handle that, which is to include gold and diversified commodities in your portfolio. Now, almost no investors who hold the 60/40 have those assets in their portfolio, but even something like a 10% allocation to both gold and diversified commodities can meaningfully protect against, tailed outcomes in a geopolitical sense or rising inflationary pressures. And we've seen that really, in the course of the last couple of years where, for instance, everyone used bonds to hedge their stocks. And the reality is that gold has outperformed bonds by 50% over that same time frame. So you'd sure as heck like to hold gold as your diversifier to stocks more than bonds over the last few years. And hopefully that's a good lesson to folks that holding more diversified portfolio can help protect you against a wider range of different outcomes.
Well, I'll tell you, Bob, this audience can be really happy with you because they do tend to love gold. Is there a way that you express it? Is it ETFs? Is it the physical, bullion, or how do you express owning gold typically?
Yeah, I think for most investors, holding ETFs are perfectly fine. There's a number of different good ETFs, GLD, IAU, some other ETFs that are out there as well that are, low cost, liquid, and pretty efficient in terms of getting exposure. Of course, in many ways, people have learned that unless you have the physical asset in your pocket or the keys in cold storage, it doesn't necessarily mean that you have ownership of it. I think that that's less of a concern when you're talking about some of these gold trusts, these ETF gold trusts that are being traded. But of course, you can always, buy the physical asset and pay the incremental additional storage cost for gold if that sort of counterparty risk is a concern to you.
Yeah, and 10%, is that like a typical allocation? Oh, no, I guess it's not, because you mentioned it was like 60/40. Very few actually have gold.
No, I mean, if I mentioned 10% gold in most instances, and everyone sort of like, their like eyes get big and they're like, wow, that's, like speaking like a crazy person is suggesting a 10% gold allocation. But, talk to your financial advisor. Go look at how a 10% allocation to gold would have improved your portfolio, return relative to its risk over the last 20 years, or since 1970. And what you see is that it's very clear that from an empirical perspective that your portfolio will be much more efficient, much better, just even from a relatively modest allocation to gold, in part because gold is relatively volatile. And so, in times of crisis has the benefit, has a strong price benefit on the upside, called, has like good convexity to geopolitical environments. So you don't have to hold a lot to get a lot of benefit from those tailed events in your portfolio.
Yeah. Well, Bob, I have to say, I enjoy having you on, and I love learning from you. And I got to say, you are so good at explaining things. And so I just appreciate you just being so generous with your time and your ideas. I want to give you, a quick moment if you'd like to share more about your work at Unlimited, where folks can, follow you on social media. Anything that you want to plug, please take a moment to do so.
Well, thanks so much for having me. I love these conversations because I think in a lot of ways you channel what's on the everyday investor's mind, and so often, people are trying to walk around, trying to outdo each other rather than just have straightforward conversations that are helping bring people along in what is, frankly, financial markets. I've been doing this for a couple of decades, and I'm learning every day. So let's all understand how humble we need to be in terms of what's going on. So anyway, I appreciate the questions. That's why I love coming on and talking to you. For people who want more information about what we're doing at Unlimited, they can definitely check out our website, unlimitedfunds.com, where they'll find a bunch of information about the work that we're doing to bring more sophisticated investment strategies to the everyday investor through the ETF structure. And if you're interested in in an ongoing flow of macro takes and perspectives, definitely check me out on Twitter at Bobby Unlimited, where I'm regularly posting and chatting with people about some of the key things that are going on in the markets.
Bob Elliott, CEO, co-founder, and CIO of Unlimited, thank you so much. Always a pleasure to have you on the show. I really appreciate you coming on, Bob.
Great. Thanks for having me.